What is up, people? Miles here with Keep the Change, and today we are rocking red everywhere because the markets are down massively. So we're going to be talking about some tips for you and your portfolio on how to manage this correction, if you will. And if you don't like and subscribe, you're going to get wet socks, and nobody likes wet socks unless you're like a freak. So the market has been down huge as of late, which is no surprise considering that we've had an insane run-up in these past few months ever since we recovered from the pandemic. Let's look at all our favorite stocks and how they've been affected. We've got Microsoft stock down 10% in a week. We've got Amazon stock down 10% in a week. We've got Visa down 5% in a week. Got Tesla here. Oh my god. Tesla is down 26% in a matter of a week. That is actually insane. Alright, we got Apple here down 15% this week. So obviously the big theme here is that all the tech stocks basically have been hit hard. All the biggest tech stocks have been trading at record valuations. Let's take a look at Apple and Microsoft here. Apple is trading at a PE of around 34 and a forward PE of around 28.
The PE is an example of what's called a multiple, a ratio that compares a stock's price to some fundamental number. Generally speaking, the higher the multiple, the more expensive a stock is considered.
It usually trades at a 16 PE to a 20 PE and a forward PE of around 15 to 20. But now the valuation has gone sky high. I mean, even with the 15% drop, they're still at a 28 forward PE. Let's look at Microsoft, another great example. Trailing PE here of 37. Usually it trades around 30. A forward PE of around 32, usually it trades around 25. So you're starting to see a pattern form. It's clear that a lot of big tech stocks have reached overvalued territory here. So what a lot of people are doing is selling their tech stocks. They're saying, hey, we've already locked in profits. Let's go to a different sector. Generally speaking, tech will go up a lot and it'll go down a lot. It's a lot more volatile than something like consumer stocks. So let's take a look at some other stocks. McDonald's is actually up on the week. McDonald's is up 1%, so not a bad place to put your money in consumer goods and restaurants. Let's look at AT&T, which is a popular dividend play. That is actually up on the week as well. So what you're starting to see is big tech take a huge dip, and recovery stocks, so stocks that benefit from basically the economy starting up again, you're starting to see those stocks kind of rally back or at least hold their value. This is basically my first tip. If you can't handle the lows that come with tech stocks, then you should probably be putting your money more into something like McDonald's stock or AT&T, just to name a few. Generally safer stocks that will move much slower than tech stocks, which tend to be extremely volatile, as we mentioned earlier. Now, of course, all of this depends on your risk management. In order to prepare for a market correction, you have to understand where your own risk management is at. If you're a 50-year-old who's about to retire and is on the brink of retirement, you're probably not going to be wanting to put all your money into high-value growth tech stocks, right? However, if you're younger, if you're a 20-year-old like me, I tend to have most of my portfolio in tech stocks. This is mainly because I believe in tech the most, but also because personally, I can handle my account going down massively in a day. For me, it's worth it to see these extremely down negative days because at least in the end, my money will grow and I feel confident in that. You should diversify. I do preach that. I think it's one of the worst parts of my portfolio is how tech heavy it is because on a week like this, I got hit extremely hard. So basically, what I'm saying is to diversify not only into different stocks, but into different sectors as well. So you don't want all in technology. You do want some other plays in there just to mix up your portfolio, keep it more balanced. However, if you're younger, you can take more risk and you can put money into high growth stocks because even though they may seem expensive now, in 50 years, you might get better returns than if you put your money in something like AT&T or a stable type stock. So I think the older you get, the more you should diversify. So this is going to be my second tip for handling stock market corrections, and that is to never get emotional when you invest. Now, emotion works two ways, right? Because when people see stocks going up, they think, wow, I've got to get in on this. I'm missing out. But when people see stocks going down, they often think, wow, I need to sell because this could get even worse. You're literally doing the opposite of what people tell you, right? People say buy low, sell high. It's so easy in theory. Now, obviously, you can't predict where the lows and the highs are, but generally speaking, you want to be buying when it's lower. You can't be scared of the red days. It doesn't benefit you to sell out of your stocks as they're going down. And there's a couple reasons for this. One, tax reason. So if you buy stock today and you sell it tomorrow, you're going to be taxed at a 25% tax rate. If you buy stock today and you sell it in 1 year, you're going to be taxed at a 15% tax rate. Your taxes are actually lower the longer you hold on to an investment. On top of that, if you missed out on on the best 10 days in the past 20 years in the stock market, your returns would have been cut in half. People need to realize that your stock going up and your stock going down means absolutely nothing for your account. Well, what I mean is that until you actually take the profit or take the loss, it's unrealized. Meaning your wealth could change in a matter of a day. Tomorrow the market could go up 10%. It could go down 10%. You're never gonna know, and it's always going to fluctuate. So why even focus on the day-to-day fluctuation? On top of that, if you're down on an investment and it's correcting even more, what you need to do is just put more money into the stock. I mean, do you think a stock like Apple or Visa is going to hit zero? Probably not. Very unrealistic. So when you see the stock dipping, you should be buying. You should welcome in the red. One of the things that I've hated about this market for the past 3 months is the fact that there's been no deals, right? We're at new all-time highs every single day. And it's almost like I can never catch a good deal on the market. I have a lot of cash to deploy, but I don't want to deploy it. Please, whatever you do, don't get emotional, okay? That number at the end of the day means nothing. That number today could change down 10%. It doesn't matter. What you care about is being a longer term investor because that's where the money is, okay? Now, my last tip, and this is tip number 3, is to always have a lot of cash on the sidelines. You don't want to be caught in a position where you have to sell off stocks just to get some cash, just to buy more stocks. It's just a bad position to be in. You always want to have emergency cash, usually around 10 to 20%, hopefully more in your portfolio, so that when a market correction and buying opportunities actually present themselves, you can actually take advantage of this. And all of this may seem super simple and super clear. However, I just wanted to make this quick video sort of for beginners in the market to really understand that a stock market correction is nothing to fear and that you should welcome it. I'm going to be doing a stock portfolio reveal on Saturday, so hopefully you enjoy that. And thanks for watching. I love you.